Welcome everyone to our Pellegrini Financial fourth quarter market call and video update, wrapping up the year 2022. And first off, apologies for a little late on this video. I've been spending the last week or more hacking and coughing away here in the office and wasn't going to work very well on video. So finally, knock on wood, I think I'm good. And so here we are trying to get this done. So thanks so much for your patience. First off, of course, 2022 was certainly the most challenging year for markets in general. And, we've talked about it many times through the previous calls, but obviously 2021 was a great year. And so 2022 starting off to see a bit of that froth come off the top wasn't surprising. Obviously, Russia, Ukraine, and the conflict there was a big issue for markets. And while temporary, that of course still led into other economic issues and factors, including inflation. Inflation tagged along. That, of course, was concerning for central banks. And in combat of inflation, of course, they went on the path of raising interest rates. And of course, they rose interest rates a number of times through the year, but more importantly, substantially. There were some pretty big rate hikes. And then, of course, that led to talk of recessions later in the year, which where we ended up now. Of course, the fourth quarter happened to be a little bit of a rebound for markets in 2022, which was nice. Obviously, we're still down for the year. And so these two little charts or graphs here, of course, didn't indicate really where all the equity indexes finished down, and some of them quite substantially in double digits. The only positive market, I suppose, was the FTSE UK market. In Canada, in particular, of course, energy was actually a good performer from a sector perspective. Obviously, it was lagging for the last number of years, so but a little rebound there was nice. Markets were still down generally in Canada, led by healthcare and information technology, which is probably similar in the US as well. When we look at our own GDP growth, and I got two charts there, one of the European and one of the Canadian market. But as we look at the European market, I guess to start with, you see, a good start to the year, generally speaking, but a pretty dramatic fall in GDP growth, in particular the fourth quarter, which is near flat to negative. Um, in the Canadian market and somewhat in the US as well, similar where it is slowing down. So economic growth has been ratcheted down uh, quarter after quarter to the point where 2023 is expected to be well, near zero and quite possibly a technical recession as we go through the year. But certainly the rise in interest rates is meant to combat inflation, but does counteract economic growth, which is kind of part and parcel. When we look at the employment picture in Canada, and I think a couple of things to look at there, participation rate, of course, has been kind of trending down as a whole for the last 15 years. Also had a big spike down in 2020 and jumped back up, and there's a little slight increase as of late, which is good. Inflation rate or employment rate is still trending down, so even right now, 5% and or so. Um, that's a good rate as a whole. I think wage inflation is going to be concerning to central banks because of the lack of employees, and that is still a problem. Is you have boomers leaving the workforce, you have fewer and fewer younger people entering the workforce, and that's a bit of a problem as well. When we look at inflation, like I said, inflation has been trending down. I think wage inflation is going to be a little stickier, but we've seen it trending basically from June of this year down all the way through to the current point. And when we look over the last 6 months, inflation is probably down to 2.9%, 3%. Month over month, it's even less. So I think by May next year, you're going to see inflation back down to that normal range. I put beside here this chart of WTI oil energy costs, which peaked basically in June of this year and matches up rather well with inflation. It is not a one-to-one correlation by any means, but I thought it was kind of curious and quite an interesting chart to look at when you look at them side by side. So energy cost is a big factor of inflation, but certainly not the only thing. Interest rates, of course, we talked. Interest rates have risen dramatically through this year, and I think the peak rate really, 4 and 3/4 probably for Canada. The expectation was maybe 5 in the U.S. The way the last reports looked in the U.S., I think getting to 5.5 now probably is not out of the question for the U.S. market. We are at the tail end, no matter what. We're looking at markets now that are priced in all the rate hikes, and it'll flatten off. and potentially probably stay at this level through 2023 and maybe ratchet down a little bit depending on how economic conditions continue on through 2023 and 2024. When you look at commodities, this is more of a focus just on natural gas in particular. So, natural gas was great through the start of the year, kind of as expected, but certainly the last half and last quarter in particular wasn't very good for natural gas. Probably the biggest thing there is the fact that um, really demand has not been there, both in North America and Europe in particular. Warm winters, of course, has really ratcheted down the demand. I think in the European market in particular, and good for Ukraine, of course, as well, that um, they did well to find supplies outside of Russia and certainly build up inventories. And so that's why I kind of have that little chart there as well. Um, again, much to the surprise of the markets, I suppose, for natural gas. But good for the price of us trying to burn our natural gas, that's for sure. Costs have come down substantially. Global currencies, this is just one chart of the US Canadian dollar. Again, it's been pretty steady through the last, 10, 15 years in that kind of range bound area. Obviously, been more favorable for the Canadian dollar as of late. And I think as a whole, it's probably one thing to watch for 2023 is the expectation of a weakening US dollar globally. Um, right now that's a safe haven currency, of course. And as we get through this, I think you'd expect to see the US dollar start to depreciate a little bit. I think the one caveat to that is interest rates and where they go. Currencies have been dictated certainly a lot more by currency or by interest rates and central banks, and that will dictate the flow of capital. Um, when we look at 2023 in the market outlook, I think the first thing that we're looking at through the start of this year's earnings now that have been impacted by inflation and a slowing economy, they're watching to see what those numbers come out to, right? They cannot pass inflation costs down to the consumer anymore. It is going to hit more of the bottom line. China's removal of the zero COVID policy and opening of their economy is kind of a big news item. Again, I would caution that a little bit. Their reopening will be no different than ours or many other countries. There's going to be hiccups, right? We were backed up for passports. Well, Chinese are backed up for travel visas. It's going to go so fast. Those are kind of things that are going to happen. So it's good for the economy to open up, but be cautious, I guess, on how fast things can move. And beyond that, I think is really kind of looking at the recession, potential recessions. And if we do hit a technical one, okay, fine. I don't think as long as people are still working, no one's really going to notice. If it's deeper and longer, well, that could be an issue. So I'll wrap it up there. And certainly thank you for joining us again for this another market update and look forward to joining you again next quarter. Thank you and bye for now.